what's actually very surprising to me is, I said before, that gold really shouldn't be at new all-time highs with the money supply falling. And the fact that it is means that there's a lot of strength here, or a lot of weakness in currencies, and just wait to see what wait what happens when the Fed really does turn around. I think you're going to see gold going up by hundreds of dollars a day, silver going up by $3, $4, $5 a day. And that's really going to panic the central banks. They're not going to know what to do. They're not going to really be able to do anything, because they'll have to choose between saving their currencies and saving their banking systems. Either way, both of them are going to die. And the only thing that's going to be left is gold and silver anyway. And then we can restart a monetary system based on that after a lot of chaos.
Gold spot prices are predicted to rise to around $2,200 in the next 12 months. Gold is not the only precious metal soaring high. According to a recent report by CNBC, silver prices are poised to reach a 9-year high in 2023, potentially outpacing gold in terms of returns. Various factors, including economic uncertainty, inflation concerns, and growing demand for safe haven assets, are shaping the market conditions. Rafi Farber, founder of Endgame Investor, anticipates that if the Fed reverses its course, gold could surge by several hundreds of dollars a day, with silver mirroring the trend. Friday's upbeat US Nonfarm Payrolls (NFP) report dampened investors' hopes of Federal Reserve Fed cuts in early 2024, giving a fresh boost to U.S. yields, to the detriment of the yieldless precious metal. In May, ANZ research analysts increased their gold price predictions to settle at $2,200 by September 2024. Analysts cited turbulence in the U.S. banking sector, high interest rates, and uncertainty surrounding the debt ceiling. Meanwhile, Rafi believes in gold's strength, noting its new highs despite a declining money supply, and predicts a surge in precious metal as the Fed resumes money printing. The money supply has seen 12 consecutive months of negative growth, with October 2023 showing a year-over-year decline of 9.33%. Regarding Farber's predictions, he sees central banks panicking over whether to save currencies or banking systems, leading to their demise. According to the expert, the subsequent banking sector collapse could happen in March 2024. Since 1933, the US dollar has lost 92% of its domestic purchasing power. Even at its moderate 1994 inflation rate of 2.7%, the dollar will lose another half of its purchasing power by 2022. Now, we present the clips of Rafi Farber's insights from his recent interview with WT Finance. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Interest rates, even though they have gone down in the last few months, they're still much higher than they have been since 2008, which they were like just constantly zero from 2008 to 2020. And now they're like between 4 and 5%. So when that extra money runs out, who buys these treasuries? I don't know. So I think the Fed's going to have to buy them, which means it's going to have to stop quantitative tightening and start printing money again. And when that happens, I think the precious metals really start to move higher. The fact that we hit a new high in gold without the Fed turning around and with the money supply still falling is significant enough to say that there's a lot of hidden strength in gold right now. And imagine what happens when they start printing again. It's going to go berserk. Gold is money, and currencies are derivatives of gold or silver. So when gold goes up, that means that currencies are going down, because the real money, the price matrix of the world, is in gold. It doesn't seem like that. People would say, oh, what are you talking about? I can't go to gold and buy food in a supermarket. But then I say, well, try to go to a supermarket with a wad of cash, or anything in your digital wallet or anything, or a credit card, and try to buy food with your currency when your currency can no longer buy gold. It won't work. That's not going to work. So the real money is gold, and the rest of the currencies are just gold derivatives, but to different degrees. The main gold derivative is the dollar, and other currencies are derivatives of the dollar, and that's how the pyramid works, right? You have gold, dollar, other currencies, debt on top of that, equities, other derivatives, etc. Or I should be going like this and not down, but it's inverted and it goes up. So who do I think is driving the gold market? It's not retail, because premiums are down. And the ETFs, the ones that retailers use to track the gold price to try to get dollar profits off of it, SLV and the GLD, their holdings in those ETFs have continued to fall. So it's not in the retail market, it's not in the physical markets, it's in the futures market. And who buys gold in the futures market. It's a ping pong between banks mostly. The ones who operate there, HSBC, Bank of America, JP Morgan, they buy and sell to each other. The futures market is what's going up. So what's actually very surprising to me is, I said before, that gold really shouldn't be at new all-time highs with the money supply falling. The fact that it is means that there's a lot of strength here, or a lot of weakness in currencies, and just wait to see what happens. Wait what happens when the Fed really does turn around. I think you're going to see gold going up by hundreds of dollars a day, silver going up by $3, $4, $5 a day. And that's really going to panic the central banks. They're not going to know what to do. They're not going to really be able to do anything, because they'll have to choose between saving their currencies and saving their banking systems. Either way, both of them are going to die, because a banking system can't survive with a currency that isn't worth anything. And a currency can't survive with a banking system where they just keep printing more money. So both of them are going to die. And the only thing that's going to be left is gold and silver anyway. And then we can restart a monetary system based on that after a lot of chaos. Don't ask me exactly how that works out. There's going to be a lot of problems, and the internet might go down in the meantime. Maybe not. We'll see. But that's what we're waiting for. That's the end game, and it means that gold and silver are no longer exchangeable for currencies, and that's what we're waiting for.
Rafi Farber warns of banking instability, foresees a critical point for currencies with the Fed printing money, and the need for trillions to support financial institutions. The failure of a bank not only affects its depositors and creditors and undermines trust and confidence in the entire banking system. He also notes a drop in extra cash and heightened stress in repo markets, similar to conditions preceding the Fed's 2019 money printing. The amount of money investors are parking at a major Federal Reserve facility dropped below $1 trillion for the first time in more than 2 years. Farber probes the system's liquidity surge, questioning why banks hoard excess funds during repo market tightness. He further cites Mark Cabana of Bank of America's view that it's a precaution against potential liquidity crunches. Let's get back to the interview.
With the way that that Keynesian economics structures an economy, when you print money, things seem like they're doing better. And though money isn't being printed right now, there's still more money coming in from the printing of 2020 and 2021, which is keeping the banking system from completely collapsing. But we already saw back in March that it started to collapse, and it's going to get much worse until the Fed starts printing money again. And when they do, that might be it for currencies, because they're going to have to print, what was it last time? It was like $4 trillion in a few weeks, or 2 or 3 trillion. I lose count, but and so this time it's going to have to be more, because when more financial institutions have more money, they lend that money out. When you print money, they lend the money out and they go into debt more, so they need more money to pay back their own debt. You need to print more, and that's why everything goes on an exponential curve in this monetary system. And we're about to head to the vertical portion of that any month now. It could be any week now. Can't give an exact time, but I'm pretty sure it's going to be in 2024. That much I can say confidently. And I could even be wrong about that. I've been wrong before, but I'm pretty confident about 2024. They're running out of extra cash, and instead they're giving it to the Treasury. On the other side, you have the volumes in the repo markets. Not that the Fed is involved in that directly yet, but repo between banks, the volume in that market has spiked, I think, by like $500 billion in a few months, and we're at all-time highs. I think the all-time high was like $1.85 trillion in a night. And we've seen before, when there are spikes in overnight loans between banks, when volume goes to new highs, that means there's some stress, because it means a lot of banks are short on cash, or else they wouldn't be borrowing it, right? So that happened in September 2019, when repo rates went to about 10%. That means the rate at which a bank would lend cash to a bank short on cash was about 10% in exchange for treasuries. And that signaled that there wasn't enough extra cash, there wasn't enough cash in the system. So the Fed had to print. It stopped quantitative tightening there and expanded its balance sheet. So it looks like we're on the verge of something like that again. It could happen around the year turn, when there's generally a spike in the repo market volume. I think it's going to happen when the reverse repos run out and there's no more extra cash anywhere. Then we're going to go into the next printing round, and however much consumer price inflation is, what people call inflation, what I call just rising consumer prices. However much they're rising, all central bankers are going to have to print at the same time. It's not just the Fed, because when the Fed prints, all other central banks have to print too, or else the exchange rates between currencies go out of whack, and then all these economies get disorganized, and the heavy interests, the special interests that the exporters that have a lot of political power or clout, they tell their central banks what to do, behind closed doors. So all central banks have to print or drain at the same time. So when the Fed prints, everyone prints, and then all currencies fall at the same time. Is this phenomenon that there is increased liquidity in the system right now, which means increased reserves? And the question is, so if it's tight in the repo market, but banks are holding on to this excess liquidity, they don't want to let go of it. Why are they doing that? And I think it was Mark Cabana of Bank of America, who's one of the head bond guys in Bank of America, like really happy. He's in the news a lot. And he says, why is there extra liquidity? He says because that banks are holding on to it, because if there is a liquidity crunch and then people start withdrawing cash or taking money out of the banks some other way, then banks would have to sell assets in order to meet those redemptions. And their unrealized losses on bond portfolios for banks, which is what brought the regional banks down, I think they're like $500 billion across the banking system. So if a bank that has unrealized losses on its bond portfolio is forced to sell to meet withdrawal requests, then those unrealized losses become realized losses, and the bank is in real trouble, and the Fed really has to bail them out. So if they're forced to sell bonds in a liquidity crunch, the Fed is definitely going to have to step in immediately.
Gold and silver prices will gain momentum following economic uncertainty and inflation concerns. Gold bugs will be looking for signs of higher spending and higher deficits as justification for their faith in the precious metal as a store of value at a time of fiscal incontinence and after an extended period of money printing. Does the projected rise in precious metals align with the current economy? And how might it affect the banking sector? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.